All right, folks, we're now going to take a look at lessee and lessor accounting. And let's take a look at this one. We're going to classify a lease, which means we're going to show a balance sheet asset and a balance sheet liability at this point in time. So in this case, this happened to be for a microscope. The lessee, that's the woman over here, she has to shell out cash, giving it to, that does look like Sugar Bear, doesn't it? Does look a lot like that handsome dude I know called Peter Olinto. So she's going to give money to Olinto, and he's going to give the product, which is the microscope, to her for use during a stated period of time. So that's the fundamentals that we have here. So how do we determine if it's a finance capital lease or an operating capital lease? Well, if the client owns it, O or a W or an N or an E or an S, if the client owns it, they should treat it as a finance capital lease. If they fail all of those rules, then it's simply an operating capital lease. From a balance sheet point of view, on the date that it actually happened, the commencement date, the journal entry would be exactly the same. The difference is going to be how we handle it on the income statement in future periods. So what is an O? Well, the O is the ownership transfers at the end of the lease. So you have to make all these payments, but after the final payment, they give you the title. You own it. Well, then it's a finance capital lease. If not that, is there a written purchase option that the lessee is reasonably certain to exercise? And remember, that reasonably assured, reasonably certain is a very high standard. That's the W. Then we have the N, which is, does the net present value of the lease payments equal or substantially exceed the asset's fair value? So as long as we've gotten really close to that fair value, then it's probably a finance capital lease. Then we have, is the major part of the economic life of the asset contained within the lease term? So economic life would be the next one. And finally, is this asset specialized such that it has no alternative use to the lessor at lease end? There's the specialized item that we're looking at right here. Now, with each of these, we ask ourselves, well, how do you determine the net present value or the economic life? I mean, how do you make those numbers? Well, chances are you can use the old standard. In the old days, when you had the net present value, it used to be 90% or more of the value was covered. And down with the E, the economic life, it was in excess of 75%. So I would use those as bare bones minimum amounts that you'd want to at least consider. So if you meet any one of these, finance capital lease. If you don't meet any of them, then it's an operating capital lease to the lessee. Well, what about to the lessor? We got to ask our good friend Sugar Bear here. What does he have to do? Well, if the lessee owns it, all right, if the lessee owns it, then it's going to be treated as a sale type lease from their vantage point. I always like to say if all the risks and rewards have been transferred, then they literally de-recognize the item, take it off their balance sheet, get rid of that asset, and report a gain on the actual transaction at the commencement date. Well, what happens if the lessee doesn't meet the owns criteria? Then what? Well, then we come down and we say, well, there's still two others, the PC rules. If both of these are met, and that is in this particular case, that we have the P, which is going to be the present value of the sum of the lease payments, guaranteed residuals from lessee not included in the payments, and any third-party guarantees equal or exceed the asset's value. That's the P, present value. And, notice the word and means both, is the collectability, in this particular case, probable. If both are met, then it's called a direct financing lease to the lessor. That's because most, not all, but most of the risks and rewards have been transferred to the lessee. And therefore, the lessor will take the asset off their books. And the gain won't be recognized immediately. It'll be amortized over the lease term. Well, if you don't meet both, now it doesn't matter which way, if you meet one but not the other, or you fail both, then it falls into the operating lease for the lessor. And an operating lease for the lessor means keep the asset on your books, depreciate the asset on your books, and then treat rental income each period when the lessee gives you a payment. So those are some of the fundamentals that are associated with these rules that we're going to now be testing on. So hopefully that helped. It warms you up, and now you're ready to try some problems.